one set of those eyeballs would be Goldman Sachs. Goldman just came out last week or the week before and said, we're no longer recommending the 60-40 mix. We're recommending 60-20-20. And to go from 0 to 20, the momentum is going to come into silver. But the problem with momentum coming into silver is it's such a small market. I don't even know what the number is now. I'm guessing it's probably 30, 35 billion per year total production, total global production. What do you got? 800, call it 40 billion, 800 million ounces. So you're talking about $40 billion, which is not even it's not even a lettuce on a ham sandwich in today's financial world. And the fact that it's such a small market has always led me to believe that the market that would break first, when I say break, the contracts not deliver, would be silver.
Precious metals mining stocks, they've been on an absolute tear in 2025. They've made an incredible run since August. What's that?
I said finally.
Finally,
it's been
yeah.
a long time. It's been since 2000.
It has been a very, yeah. So, since August 1st, they've just gone absolutely ballistic. So many investors, like you're talking about, they've been scarred from the end of the last bull cycle in 2011 and the way the mini runs in 2016 and 2020 unfolded up and down. It's really left people, very scarred. So they're constantly worried about a crash in the mining stocks coming. That said, the cycle is so different than any of the previous ones for so many reasons. What's your perspective on the run-up of these miners that they've had and what comes next for them?
In my opinion, this is not even jacks for openers. And the reason being, miners learned their lesson in 2011. They got fat, they were spending money, they were wasting money. You've got, companies are much, much leaner, and this last 10 to 15 years is directly in the front of their mind. So I think the margins are going to be huge. And actually, I did an interview earlier today and kind of brought up some really old history, like 100+ year old history. If you go back to the late 1800s, early 1900s, because the price of gold was pegged at $20 and their cost of production was very well known, mining companies actually were treated like utilities are treated today because they were paying good dividends. They were stable businesses, and I think that's where we're probably headed toward a some type of number. And I don't think the number even resembles anything close to where we are, but some number on gold, some number on silver that becomes the new benchmark, if you will, that we don't stray too far from that. And I think it would be easy for the BRICS to do that. My past partner who passed away, Jim Sinclair, used to say, what's from keeping China saying $50,000 bid on gold, $50,000 offered, what do you want to do? And I think we're going to get to a point where the price is going to be, if you want to call it pegged. I'm not exactly sure how that would be done, but I think we're going to get to a price, and then people are going to start doing calculations differently on mining companies than what they're doing right now. I think they're going to look at mining companies as a stable cash producer, and something that's not being rewarded right now that always was in the past prior to 2011 was reserves in the ground. I think it's my belief that mining companies that have big reserves in the ground are finally going to get paid for those reserves. Because for the last, since 2011, since that peak, nobody cares one whit about how much is in the ground. They want to know what the production is right now. What's the cash flow? What's your cash burn? What's your cost of production? That's the primary way to value companies now. And I think that's going to change, and we're going to go retro to the way mining companies used to be valued, and that's based on how many ounces in the ground do you have? And how likely is it
Yeah. So
that
where
you're going to
we,
find more ounces?
yeah. So where it's been overwhelming majority eyeballs on tech and bonds, we're now going to get a significant rotation of eyeballs from the investor community back onto natural resources, mining companies, et cetera.
Well, one set of those eyeballs would be Goldman Sachs. Goldman just came out last week or the week before and said, we're no longer recommending the 60-40 mix. We're recommending 60-20-20. And to go from 0 to 20
Exactly
in the
right.
gold sector, that's got to be a lot of money.
It's insane. It should, at the very least, it should get a lot of those portfolio managers that have 0% allocation off the bench, right? And to have some type of allocation, which to go from 0 to 10% is a huge jump. All right. So within this precious metals bull cycle, Bill, there's an investor element that didn't exist before. It's a significantly large cohort that they just seek volatility and risk everywhere. Like cryptos, NFTs, if you remember AMC, the way that spiked, they're seeking volatility and risk, right? So silver, it's more volatile and risky as an investment than gold. So as silver usually moves further and faster, but just near the end of the bull cycle, do you expect the action this time around in silver to get more volatile and crazy compared to the previous cycles because of this cohort that is chasing risk like NFTs, crypto, AMC, et cetera?
Yeah, you're talking about momentum traders, and yeah, absolutely. The momentum is going to come into silver, but the problem with momentum coming into silver is it's such a small market. I don't even know what the number is now. I'm guessing it's probably 30, 35 billion uh, per year total production, total global production. What do you got? 800, call it 40 billion, 800 million ounces times
800 ounce. Yeah.
$50. So you're talking about $40 billion, which is not even a ham. It's not even a lettuce on a ham sandwich in today's financial world. And the fact that it's such a small market has always led me to believe that the market that would break first, when I say break, the contracts not deliver, would be silver. You mentioned NFTs. I just posted that on my website last night. There was an article talking about how NFTs are largely going unbid now. Well, what did people expect? If you pay something for nothing, how do you expect to get something plus a profit or anything at all back if you're trying to sell nothing? You've got to have a greater fool than you are. And if you put money into an NFT, which is nothing to begin with, well, you're the fool.
Yeah. All right. So I just want to ask one question about the general markets here, Bill. The Trump administration is pulling every lever in order to run the economy hot. They want to have economic growth to outpace the growth of debt since Doge and austerity failed. And let's be honest, it's really impossible in this political environment to have any kind of austerity. Nobody's going to go for it. So with that said, as they're pulling every lever, are the markets going to melt up like the dot-com boom and maybe worse?
There is a significant chance of that, but I don't think it would last much more than a month or 2 months. I think it would be a flame out rally, if you will. The bottom line, the ultimate result is hyperinflation because the currency dies. And all you have to do is look at Weimar Germany, look at Venezuela, look at Russia in the 1990s, look at Zimbabwe, look at these countries that have blown their currency up. What was it, last year or the year before? The best stock market in the world was Zimbabwe in their currency terms. And what happens is, yeah, you get when the currencies blow, you get a scare in the markets and they'll drop, 25%, 50% even. And then they stop going down. And then all of a sudden they turn around and they start going straight up. But they only go up half as fast as the currency goes down. So you don't lose everything, but you lose purchasing power. Now, you compare that to gold. Look what happened to gold in Weimar Germany. What was it? 3.7 trillion Reichmarks for 1 ounce of gold. And at one point in time, I think the number was in 1916 or 17, they were 170 Reichmarks per ounce. And it went from 170 to 3.7 trillion in 6 years. And that's without computers.
Yeah, and I think to excuse me, to your point, wasn't it something like a couple of ounces or whatnot could buy an entire city block? A couple ounces of gold would buy you a city block.
The story, and I think there is some validity to this, was that a bellboy in, I think it was Munich, was tipped 1 ounce, and he saved that 1 ounce. And as time went on, things got worse and worse. The currency debased, and of course, ultimately they redid all the debt in grams of gold. So the banks didn't get killed; it was the borrowers who got killed. But that bellboy ended up buying the hotel that he worked for with that 1 ounce of gold.
1 ounce of gold. That's amazing.